Hello everyone, welcome to this special webinar produced by Skybound Capital, where we're going to be focusing in on the Skybound Capital Prism Fund, which is the flagship fund of the Skybound Capital Group, with a live track record of over 13 years now. And those who have stayed close to the Skybound Capital Group will know that the group has evolved into managing what we term as private capital, which incorporates various asset classes, of which private debt is one. And Skybound was one of the first companies, certainly in South Africa, to enter the asset class of private debt and launched the Prism Income Fund back in August of 2009. And since then, it has evolved over its 13-year track record, providing diversity of geography and also in terms of sector where it lends its private debt solution. So what we thought we would do today is to get various members of the Skybound Capital team involved to tell you a little bit about the evolution of the fund, where it stands today in an interesting time, an interesting environment of rising interest rates, of inflation, and how that impacts the way the fund is managed, but how the asset class can still hold its own in these challenging times. So it's my pleasure to introduce the Group CEO of Skybound Capital, Conrad Am, to start off this discussion. And Conrad, perhaps the best place to start is to reflect on the growth in AUM of the Prism Fund. When it began its life in 2009, private debt was a relatively unexplored asset class, and it took its time. Yes. But over the years, it's matured, it's diversified, and has grown its AUM. So perhaps you can give us a sense of where the Prism Fund is in terms of its global assets under management.
Thank you, Matt, for sure. Thank you for the introduction. We started the fund in October 2009, and it was just after the financial crisis. We had $10 million that we raised. It took us about 5 years to get to $100 million. And today, as at the end of July, we're now sitting on $575 million in assets under management in the Prism suite of funds. Even this year, which has been a difficult year for various asset classes, we've raised $44 million to the end of July this year. We are still seeing steady subscriptions in the portfolio, about $7.7 million on average per month over the last 12 months, with about $3.2 million of redemptions on a monthly basis over the past 12 months. So still seeing about $4 million of positive inflows on a monthly basis into the Prism Fund.
So $575 million US, it's a substantial amount under management, but just drilling down into some other statistics that you'd like to highlight around the fund?
Absolutely. So as you mentioned, we've been running 13 years now. From inception, the fund's annualized at about 7.7% in the dollar class. Over the last 12 months, we've done about 6.1%, which relative to equities and bonds, which are sort of double digit down in both asset classes, a 6.1% return over 12 months is pretty good and very stable and steady. We obviously would like this return to ramp up a little bit to over 7% and back towards that 7.7 annualized. And we are working on that, and this will come out through the discussion today.
Yeah, well, we are going to call in various members of the team to discuss that performance and how you intend to ramp it up. You mentioned the $575 million, but also important to note that the fund is available in other currency classes, although that does come with a hedging cost implication.
Yes, Matt, that's right. So we offer the fund in dollars, euros, and sterling. And we have investors in all those currency classes. Some of the other portfolio statistics around the Prism suite, we now have about 100 different loan tranches out there, come down a little bit from around 120. We still deal with 50 different counterparties or businesses that we provide debt funding to. That's been pretty stable and steady over the last couple of years. Our average loan size now is about $4.5 million, grown from around $3.5 million. And our weighted average duration on the portfolio now sits at around 400 days. So that's come down from over 500 days, which creates more liquidity in the portfolio.
And also diversity, because those are important statistics. You've got a lot of loans maturing at different times now.
Correct. So I think in the current interest rate environment that we're in, with rates rising rapidly on the back of inflation, we are looking to roll maturing debt into our higher interest rates. Loans where instead of locking into on average about 10.1% across the portfolio, it varies from 8 to 14 depending on the security that we can obtain. All the debt is secured, but debt that's maturing now we would like to roll at maybe 1 or 2% higher than where it currently stands. All our loans have fixed interest rates, so that gives us the steady and consistent return profile.
It's probably fair to say that when you launched this fund, it took a while to attract investor attention, but you've certainly done that. And is there some vindication that you feel, given the growth of the asset class in general, not just the Prism Fund per se, but this is an asset class that is being taken very seriously?
Especially under the current economic environment, private capital has really stood the test of time now. This is private debt, private equity, special opportunities, trade finance, because they've offered an uncorrelated return. And I think people who've been invested in equities with a bond investment as an asset class hedging your portfolio, we've had a 40-year bond bull market now, and that started to turn. So bonds haven't provided the protection that they normally provide, whereas private debt, private equity, special opportunities, mezz debt linked to property deals have provided very good, steady, consistent returns that are uncorrelated to traditional asset classes.
Well, as promised, we are going to drill down into some more detail around the Prism Fund with some of the operational team. But just taking a step back now into the Skybound group, I mean, so much about what the group does in the fund management process, even in the identification of companies to which the fund is prepared to loan. So much of it is about people. And I know in the fund management space at a group level, you've made some key new hires in key positions.
Yes. We've actually brought on board 4 new people in Mauritius now. So Robin Smither is the Managing Director of Skybound Capital Limited and on the investment committee of the Prism suite of funds. Rob has 15 to 20 years of investment banking experience, specifically in the private debt world, working for a bank, allocating large amounts of balance sheet capital into private debt opportunities. So it comes with a lot of experience. We then also hired Rakesh Cisaran, also from the banks on risk, fantastic on IFRS 9 policies and procedures, valuations, and has been a tremendous support to the Skybound fund management team that sits within the Prism Fund. We also brought on board Head of Compliance and Governance, Carlo Casilegio, also 15 to 20 years of experience, also based in Mauritius. And Warren has joined us recently to look at valuation and IFRS 9 to support Rakesh in the valuation modeling around the private debt positions that we have.
So there's a lot of fund management experience there, but a key message that is coming through there is around governance.
Absolutely. So Carlo and the team in Mauritius have created tremendous substance. We've actually employed an independent non-exec board director in Mauritius. So a lot of effort and emphasis has been placed on policies around conflict of interest, governance, business code of conduct, and that's all filtered through into the Prism suite of funds and what Skybound does globally as an asset manager. So this team has added a lot of value. We see a lot of opportunity in Mauritius for expansion for the Prism Fund. There's deals that we can link on to the back of some of the banks in the environment there. There's a lot of African debt opportunity around. So it's really opened up a pipeline to Skybound as well.
So Mauritius has been an invaluable jurisdiction for the fund and for the group as a whole, but also some news around another jurisdiction.
Yes.
I know you've spent a lot of time working on a Luxembourg-based structure.
Yes, we finally have a Luxembourg CCAF RAFE structure set up for the Prism Fund. It's available in dollars, euros, sterling. We could potentially add Swiss franc as a currency class. And it's a small fund. It takes us back to when we launched the Prism Fund back in October 2009. We just shy of $10 million of assets. We're building that portfolio slowly, but it is open for business and investors can allocate. If they prefer a European jurisdiction, they can allocate through our CCAF RAFE structure in Luxembourg instead of the PCC structure in Mauritius.
Well, great to get that overview of the Prism Fund from Conrad, for which many thanks. Next, we're going to start, as promised, going into some more specifics of the fund. And we're going to be talking to fund analyst Sigmund Thetard about the diversity available in the fund through geography and sector and some of the new opportunities that the team is looking at for the fund.
Yes, Matt, thank you very much. So over time, we have grown from Africa through to Australia. We've grown from consumer finance to real estate and other sectors such as information technology, IT services, etc. We have further opportunities that we can grow into in the SME funding space as well as trade finance. And slowly but surely, as the fund has grown, we have increased our team complement. We have been able to add more counterparties to the mix across all the sectors. And currently we are present in the USA, UK, Europe, Africa, as well as Australia and the rest of the world. And sector diversification, I think we are looking at about 20 plus across consumer finance, SME funding, real estate funding, as well as we increasingly trade finance as well, which improves not only the liquidity of the fund, but gives us more opportunities further into the future. When we come to, as you mentioned, looking at the risk-adjusted returns of the fund and maintaining those returns, what we are doing is we're looking at new opportunities, and we've got a pipeline of roughly $75 million that we can grow the fund with over the next 6 to 12 months. That pipeline, we have added trade finance and SME funding to the mix, and we are looking at increasing rates of about 100 to 200 basis points on a risk-adjusted basis. We are increasingly focused on the security that we get behind this funding that we are advancing to counterparties, and many of these are essentially on a senior secured basis in the UK and Australia, where it's very easy to perfect the security on these. As an example, we are currently advancing and finalising an opportunity in Australia for merchant capital advances. SME funding is, by its nature, actually very low risk, because the expected bad debts that you get there is around about 4%. It never goes above 8%, which compares to consumer finance where it can go 10% plus. The book is very short. We are advancing on terms of 2 years. We are senior secured in this opportunity, and the type of return that we can get there is about 125 basis points above what we are currently achieving on gross returns in the fund. So we are seeking similar opportunities like this, and we're seeing that coming through as well in trade finance and real estate. What we have found in the space is that because we have been around for a very long time, over a decade, success breeds success. So we are finding opportunities on a referral basis or with our current counterparties where, even though we still have to do the due diligence, we actually do trust the people that sit behind these opportunities. And that helps us not only due diligence even deeper, because they trust us as well with the information, but we can very effectively distribute the funding into these opportunities going forward.
So we've heard from Sigmund about how the fund has become more geographically and sector diversified over its 13-year lifespan. And with that has come a certain element of complexity. And one vital component of the fund is that it stands up to independent scrutiny. So we chatted to Nick Graham about the audit process that the fund follows, not only the fund as a whole, but all the underlying positions in the fund. And Nick is also going to speak to us about some of the performance drivers for the fund in the future.
Each year, it is a statutory requirement for the funds to be audited externally. Our external auditors are Deloitte and Mauritius. With the 31st of December year end, we typically start the audit process in November each year, with auditors concluding their planning and preliminary audit work. And the final audit work typically takes a couple of months post year end. Key areas of audit focus for the auditors is the accuracy and completeness of subscriptions and redemptions within the fund, accuracy and completeness of income, expenses, and their allocation to the various classes within the fund, and then the accuracy of valuation of investment assets, particular focus on the provisioning levels within the fund, given that it is a debt fund. The financial statements are prepared under IFRS, which is the International Financial Reporting Standards, And the extract from the most recent financial audit report concluded, in our opinion, the accompanying financial statements give a true and fair reflection of the financial position of the fund as at 31st of December 2021. In addition, the auditors consider the compliance with the Mauritius Code of Governance and concluded that in the assessment of the disclosures included in the fund financial statements that the fund has complied with those requirements of the code. So simplistically, there are 4 key drivers that impact fund performance, and I'm going to spend a little bit of time taking you through those four drivers and what we are seeing in current performance. So the first driver is the lending rate. So the portfolio is made up of fixed interest rate loans. This does create a consistent return profile, irrespective of the current market conditions, which is downside protection for our clients. That being said, the rate in which we lend to new counterparties will be informed by current and projected market conditions over the loan term. Therefore, as Conrad highlighted, we do believe that there are now opportunities to increase our portfolio's average lending rate. However, this does take time. The second driver is hedging costs. Now, the fund has foreign currency classes, so the current economic climate has resulted in increased cost of hedging due to the volatility in currency. And the third driver is cash holdings. Now, the fund maintains a liquidity target of between 5 and 10% typically in its treasury. The fund has increased this cash level in response to macroeconomic factors, which does temporarily impact their performance. However, we do believe that the current levels are well suited to allow the fund to essentially take advantage and protect 3 key things. So one is to capitalize on new opportunities that will ultimately increase the average lending rate in the fund. The ability to allocate into existing counterparties, whether that's to take advantage of their own opportunities that may be presented, or to build in greater stability to their operations, which is beneficial to the long-term outlook of the fund. And then lastly, to protect the integrity of the short redemption terms that we offer to our clients. The final key driver is the provisioning. So the fourth and final is provisioning. So being a monthly priced fund, we continuously assess the level of provisioning in the fund in line with the expected credit loss model, or ECL principles. In that assessment, it is required that the model incorporates information of past events, current conditions, and importantly, forecasts of future economic conditions through what is called forward-looking information, which is quite relevant given the current economic environment. Now, these considerations are then used to determine what are a range of possible outcomes and their respective probabilities of occurring when applying judgment in reaching a provisioning level. In periods of increased economic uncertainty, like the peak COVID period we saw in 2020, which did impact fund performance, the economic risk factors currently forecasted are requiring that we hold an increased level of provisioning in the fund. But we believe that this is both a prudent and correct approach for the time being.
So how does Prism fit into the private debt class? For an asset allocator, the liquid markets have been a nightmare. For instance, in the US, if you look at the S&P over the last 12 months or so, in fact, even year to date, it's down something like 25%. Yields on the 10-year bond are now currently at 3.68%. And bear in mind that they used to be just over 1.5%. So that's the extent of the move. And critically, if you look at inflation, which has really derailed everything, it now stands at 8.3% from having been as low as 2%. So that's the scale of the shift. And all the talk in the market about inflation, where it'll go from here, has it stabilized, will it turn? That's really what's causing headaches. So in terms of fixed income in portfolios, traditional theory states that fixed income and equities have been negatively correlated fixed income component, which carries the lowest risk weighting, is the backbone, is the stabilizer in any portfolio. Unfortunately, given the way things have gone over the past 12 months, that has not been the case. In fact, they've been positively correlated. In fact, most stock portfolios, most security portfolios have suffered because of the fixed income component. We saw what happened in the UK only last week. So what's the alternative? Well, this is the reason why more and more investors are turning to private debt as an asset class, as a substitute for that fixed income component, where they can afford to be a little bit more relaxed with liquidity. And within the private debt class, direct lending is easily the most dominant category. It provides an alternative. Why? Well, for a various bunch of reasons. First of all, by its nature, because it's private debt, market risk has been stripped out because we're investing in unlisted securities. That's by design. That's because we want to focus just on credit risk. Secondly, because it's not available through any share class listing, there are no premiums and discounts involved. So it's not like these closed investment trusts. It's a very different animal, this. There is only one price, the NAV, and depending on the nature of the fund, that's priced usually monthly. Certainly Prism is priced monthly. The other feature about this type of lending is that the lending itself is bespoke by nature. It's designed to match the perceived risk of the counterparty that we're lending to. And this is reflected in a few things, particularly the return that we charge, and secondly, the security or the collateral that we keep in case things go wrong or wherever a situation becomes stressed. And the other advantage also with this strategy is that we can enforce changes where necessary. So for instance, if the underlying companies are not doing what they are supposed to be doing based on our dashboard, we can step in as and when the situation requires it. We prefer not to do this. We're investing in the management, but there are times that that situation may arise. So coming back to something I said earlier, the key factor here is liquidity. If you absolutely need to have access to your money on a daily basis, then Prism is not going to be the right product for you. It is not a daily dealing instrument. However, if you can tolerate some degree of illiquidity, then it becomes a very interesting product to consider in your portfolios. Where I think we stand out over so many other private debt funds is that we are able to offer monthly dealing. And that's a function of the way our liquidity profile works. We always keep a certain amount in cash, typically 5 to 10% in cash. Then we start building a ladder based on the duration of the underlying investments. We are seeing more and more opportunities, as some of my colleagues will have alluded to previously, in shorter duration investment opportunities. That really helps with our book. So as a result, on a weighted average basis, we actually have a very good liquidity profile. That's why we're able to offer monthly dealing. If you look at the general stats, and this is certainly based on Q2 data this year by Preqin, 56% of people are targeting direct lending as a strategy in their portfolios over the coming 12 months. Now that is up from 43% at the end of Q1. In addition, private debt has raised something like $93 billion for the first half of this year. That's to the end of Q2. Direct lending out of that is almost half. It's 45 billion. It raised 25 billion in Q2 and 20 billion in Q1. And across the board, these private debt funds have dry powder, i.e. cash, to the tune of over $400 billion. So depending on the size, they may or may not be struggling to deploy that. That's why we target a very specific size in terms of what we do. Hopefully that gives you an idea of how to use Prism. In summary, think about your liquidity needs. And if you can afford to invest in situations where you do not need access to liquidity on a daily basis, then it's definitely worth considering. Prism is offering 7 to 8% annualized, and that is a very powerful tool to have in your portfolio in terms of mitigating risk. Thank you very much indeed.
Well, as always, some fascinating insights from Skybound Capital's Group Chief Investment Strategist, Jabir Sadawala, not only on the Prism Fund itself, but also how it fits into the private debt asset class, and indeed how that asset class has grown and attracted more attention over time. What we've tried to encapsulate in this webinar is a brief overview of the Prism Fund and how it's grown over the last 13 years and some of its strategic objectives for the immediate future. But it's impossible to encapsulate everything in a forum this short. So if your interest has been sparked by the webinar, or if you would like to know more, we'd encourage you to get in touch either by phoning one of the Skybound Capital offices or looking at our website at www.skyboundcapital.com, and our team will be happy to answer any queries you may have.